There's one number that I recommend a client know. And no, it's not their credit score, it's their DTI, otherwise known as your debt to income ratio. Most lenders just refer to it as your DTI. Today, I will explain DTI and show you how to calculate it in 3 easy steps. This is something you should know before getting pre-qualified. The DTI is a good way for a lender to determine if you can afford a mortgage payment. Most lenders have 2 DTI components: the front end, otherwise known as the housing ratio, and the back end. The front end ratio shows the percentage of your monthly gross income that would go towards housing expenses. For example, monthly mortgage payment, property taxes, homeowners insurance, and HOA dues. The back end ratio shows what portion of your income is needed to cover your debt obligations, plus your mortgage payment and housing expenses. I'll walk through an example and give you a link to an online DTI calculator. You can use it to make the calculations easy. Step 1, you need to know your gross monthly income. This is how much you make per month before taxes are taken out or any other deductions. You can take your salary or the amount on your W-2 and divide by 12. Or if you're hourly, take the last 30 days of pay stubs. You just need to figure out what income you're bringing home every month on a regular basis. According to ZipRecruiter.com, the average salary in Texas in 2022 is $56,536 a year. For this example, I'll round up and use $60,000 per year. Divide that by 12, which gives us $5,000. Step 2, you need to figure out your recurring monthly debt. Debt may include credit card payments, auto loans, student loans, personal loans, alimony, child support, and pretty much any debt that will show up on your credit report. Keep in mind that utilities, groceries, insurance premiums, healthcare expenses, and daycare are not part of this calculation. Remember that when calculating credit card bills, use the minimum payment and not the entire balance. You need to know the minimum you will need to pay every month to keep your account in good standing. For this example, we have the following debt: a Visa payment of $150, American Express payment of $200, car payment of $400, student loan $300, for a total debt of $1,050. If your student loan payment is not fixed but is income-based, then this is calculated differently. I'm going to do another video on how to calculate this based on the loan type you're getting, so please like and subscribe to be notified when a new video comes out. Step 3, you need to take the recurring monthly debt and divide it by your gross monthly income. In this example, we take $1,050 divided by 5,000, we get 21%. This is your front-end DTI. Most lenders want to see a front-end DTI that is less than 28% and a back-end that is less than 36%. This varies depending on your credit score, savings, assets, and down payment. For conventional loans backed by Fannie Mae and Freddie Mac, lenders accept DTIs as high as 50%. Now, in this example, they are looking at a $350,000 home that will have a mortgage payment of approximately $1,800 a month. Total debt is now $1,050 plus $1,800 of mortgage, which is equal to $2,850. Now we take the $2,850 divided by 5,000, we get 57%. This DTI is too high. Most lenders will not give this loan. What will happen is that you will be pre-qualified for less. A mortgage of $750 will get this person a DTI of 36%. They need to start looking at a home that is less than $125,000, or they need to focus on paying down their debt. I recommend you know this number before you get pre-qualified. Remember that if you're married, you combine your debt and combine your gross monthly income to determine your DTI. If you have any questions, just comment below. Please like and subscribe to my channel. Look in the description below for links to the DTI calculator as well as the mortgage calculator. These calculators can make your calculations easy. If you are a first-time home buyer, please subscribe. I have a lot of videos about the home buying process.